Welcome to Topic 7, Accounting for Income Tax, Part 2 for Financial Reporting session. For this topic, we will have temporary difference discussion, tax base, and deferred taxes. We'll also cover unused tax losses, revaluation, and offsetting of deferred taxes. Now, when you talk about temporary difference, it is the difference between the carrying amount of an asset or a liability and its tax base that the entity expects will affect taxable profit in the future. So, when you talk about temporary difference, it is actually an effect of application of tax rule in determining taxable profit against the application of accounting rule or standards for presentation of financial statements. So these two terms are really important in our discussion. The first one is carrying amount, and the second one is tax base. Now, carrying amount, again, it's quite simple, as we discussed in the previous discussion. And this is the one that you have been familiar with when you studied accounting. So you can see this in the accounting records. While tax base is the amount that is attributed to an asset or liability for tax purposes. Now, there will be two types of taxable or temporary differences. We have taxable amount and deductible amount. Now, in taxable amount, it is the result of taxable profit of future periods when carrying amount of an asset or liability is recovered or settled. So taxable amount creates deferred tax liability. Now, a deductible temporary difference will result in deductible amount. Okay, so determining taxable profits or loss of future periods when the carrying amount of the asset or liability is recovered or settled, and it creates deferred tax asset. Now, to put it in a simpler perspective, deferred tax liability is where you are delaying payment of certain tax. It doesn't mean that you're avoiding the tax, but because of the difference on the recognition of revenue or expenses, it may arise. And because of that, you actually had recognized possibly more income tax expense against income tax payable. So which means you recognize more income tax expense comparing with the liability to IRC. In the same way, deferred tax asset is, in effect, you had paid the tax ahead of the usual period. Again, you are not trying to transfer more money to IRC. It is again because of the difference between the tax rule against accounting standard, and this arises. Now, when you calculate deferred tax liability, taxable temporary difference multiplied by tax rate, and deferred tax asset, deductible temporary difference multiplied by tax rate. Okay, so let's try to see the journal entries here. So for deferred tax liability, the tax payment have been effectively been deferred to future periods. Tax is reduced or saved in early years, but additional tax will need to be paid later. So as I mentioned a while ago, you are paying tax, but the payment of tax may not be equal to the recognized expense. So in effect, you are saving something, but it doesn't mean that you will save it and it becomes an income. It is actually becoming a tax payment, or will become a tax payment in the future. So the journal entry to recognize deferred tax liability will be debit income tax expense and then credit deferred tax liability. Now with regards to deferred tax asset, the opposite will happen. You paid, in effect, you are paying income tax ahead of the accounting period. So the journal entry here is the debit deferred tax asset and then credit income tax expense. Now when you try to reverse the DTA and DTL, of course you just have to reverse the entry. So for reversing deferred tax asset, you have to debit income tax expense and then credit deferred tax asset. While deferred tax liability, when you reverse it, that will be debit deferred tax liability and credit the income tax expense. Now, tax base, there are things that we have to be mindful of when we try to calculate for tax base. So the formula for tax base will be here. Carrying amount plus future deductible amount less taxable economic benefits. So let's go through it. Carrying amount, it's obvious that you know what is carrying amount at this point. While deductible amount is allowable tax deduction in future years in respect of the asset. While taxable economic benefits is expected as cash flow from the use or sale given existing tax laws. Alright, let us see an example here. So we have a plant with 3 years depreciation. The cost of the plant is 500,000, and then accumulated depreciation we have 300,000. So the carrying amount is 200,000. Now as per tax rule, the depreciation should be 25%. So which means 500,000 multiplied by 25% per year, there should be 125,000 as depreciation. So we have 3 years, we have 375,000. So tax base will be 200,000 plus 125,000. That is the future deductible amount, and then less 200,000. That is the future taxable benefit. So we have a tax base of 125,000. So carrying amount, which is 200,000, less tax base 125,000, you have 75,000 kina here. So that is the taxable temporary difference. And then when you multiply it by 30% here, you will have 22,500 kina as your deferred tax. So journal entry will be debit income tax expense and then credit deferred tax liability. Okay, for tax base of liability, the formula will be carrying amount less future deductible amount plus future taxable economic benefits. So let's try to solve a problem. Okay, provision for warranty, okay, was 100,000 kina. As per IRC, warranty is only deductible when paid. So in this case, there were no payment made for warranty. So let's try to see the table below. Carrying amount, that is 100,000 kina, less future deductible amount, 100,000 kina. The reason why it's a future deductible amount, currently you are not allowed to deduct this as an expense as per IRC. Take note, we're talking about the IRC rule. Now, in the future, which means maybe next year when we paid these provisions, then it will be a deductible amount. So that is the reason why we call it future deductible amount. Now add future taxable economic benefit. We don't have economic benefit here in the future because when you already claimed it as an expense or deduction in the future, there's no economic benefit in the future for this. So here we have tax base, okay, 0. Okay, remember the formula a while ago? Carrying amount less future deductible amount, add future taxable economic benefit, then the result will be tax base. So the temporary difference here will be carrying amount less tax base, which is of course the difference will be 100,000 kina. Alternatively, you can determine the difference between carrying amount and the amount allowed by IRC and then multiply it by 30%. Then you will see, or you will determine the deferred tax. Okay, so let's see this simplified analysis on determining deferred tax liability and deferred tax asset. Okay, well, let's focus on asset accounts. So it may include machines or plant or receivables. If carrying amount is greater than tax base, that will result to taxable temporary difference. And then when you multiply taxable temporary difference by the tax rate, that will result to deferred tax liability. The opposite will happen if carrying amount is less than tax base. That will result to deferred tax asset. Okay. So the difference between carrying amount and tax base on the second line, that will be deductible temporary difference, and then multiplied by tax rate, you will have deferred tax asset. Now for liability account, the opposite of what we have done on asset. So if the carrying amount is greater than tax base, that will result to deferred tax asset. Okay. So the difference between carrying amount less tax base for liability account in the first row for the liability account analysis, that will result to deductible temporary difference. And the opposite will happen if the carrying amount is less than tax base. That will result to taxable temporary difference. And if you multiply it by 30%, that will result to deferred tax liability. Okay, with regards to recognition, a number of assumptions are made. The entity will remain in business or still under the going concern status. Taxable income will be derived in future years. Recognition of deferred tax asset is the same as applied to other assets. So which means we are on the reliance regarding probability. Unused tax losses can be applied for the next period. Okay, but how to do that? Okay, so losses incurred in future years or previous years can generally be carried forward to offset taxable income derived in the future. And it will create what we call deferred tax assets. Okay, so you have to refer to the tax law of Papua New Guinea with regards to how many years you will be able to carry forward the deferred tax asset, which came from an unused tax loss. Alright, next topic is with regards to revaluation of non-current assets. Revaluation of non-current assets can create temporary difference. The revaluation increment is not deductible for tax purposes. The tax base is not affected by revaluation. Any increase in the carrying amount through a revaluation undertaken to recognize an increase in fair value implies an unexpected or expected increase in the future flow of economic benefits. And in this case, it will create deferred tax liability. Example, okay, or journal entry to recognize deferred tax liability coming from revaluation. So to record the recognition of deferred tax liability, that will be debit asset and then credit gain on revaluation. And then at the end of the period, you have to close that gain on revaluation to revaluation surplus. So debit gain on revaluation under OCI and then credit revaluation surplus. Then afterwards, you have to recognize deferred tax liability. Okay, so debit income tax expense and then credit deferred tax liability. Okay, this is an example of the recognition of revaluation. Okay, so Daewoo Limited acquired an asset 1 year ago for 900,000 kina. Its fair value is now 1,200,000 kina, and we have tax rate. So we have an increase or evaluation increment of 300,000. So 1.2 million less 900,000 kina, we have 300,000 kina. So to recognize that revaluation increment, debit asset and then credit gain on revaluation. Now, the second journal entry here, I just want to point out, this will be done at the end of accounting period. This is the closing entry. So debit gain on revaluation and then credit revaluation surplus, 300,000. Now after that, then you will recognize the deferred tax liability. So debit income tax expense and credit deferred tax liability. We have 90,000 kina here. That 90,000 kina, if you multiply 300,000 kina by 30%, you have the result or product of 90,000 kina. Now, offsetting deferred taxes and deferred tax liabilities. Given that in most cases the tax is payable to the same authority, in this case IRC, IAS 12 requires that if certain conditions are met, then both current tax liabilities and current tax assets, as well as deferred tax liabilities and deferred tax assets, be set off against one another. Only the net amount of each set off be disclosed in the statement of financial position. So if the deferred tax liability is greater than deferred tax asset, you will offset deferred tax asset against deferred tax liability, and the line item that will be presented in statement of financial position will be the higher amount or the higher account that will be deferred tax liability. Okay, continuation of IAS 12.74 requires an entity shall offset deferred tax assets and deferred tax liabilities if and only if the entity has a legally enforceable right to set off current tax assets against current tax liabilities and deferred tax asset and deferred tax liabilities relate to income taxes levied by the same taxation authority on either the same taxable entity or different taxable entities in which intend either to settle current tax liabilities and asset on a net basis or to realize the asset and settle the liabilities simultaneously in each future period in which significant amounts of deferred tax liabilities or assets are expected to be settled or recovered. Now, if you will recall your discussion in PNG taxation, and you know that GST inflow and outflow, we are offsetting it. It is the same as what we will do for deferred tax assets and liabilities, as long as the conditions mentioned in IAS 12 will be satisfied. Evaluation of the asset created by IAS 12. Deferred tax asset might not meet IFRS framework definition of asset. Okay. So we know that asset a resource controlled by entity as a result of past events, and we're expecting future economic benefits from that particular asset or resource coming to the entity. Okay, at reporting date, the company really has no claim against the government for the value of the deferred tax asset. The realization of benefit will only arise if the company earns sufficient revenue in the future and if the relevant tax legislation does not change. It is questionable whether benefits are actually controlled by the entity at the reporting date, as there might be a contingent element involved. Okay, so we'll look into the deferred tax liability now. When the deferred tax liability exists, the company is not presently obliged to transfer funds of an amount equal to the balance of the account. Funds will only be transferred in the future if the company earns sufficient revenue. So which means there is a dependency on future events, not past events. So it means that there are some issues on whether we have to recognize liability or deferred tax liability, because it depends on future events, not past events, which is one of the requirements to recognize liability. Also, an assumption that the relevant taxation legislation will not change. And that's my presentation for income tax accounting, lecture for part 2. So that's it. My presentation ends for part 2 of income tax accounting lecture session. For the next presentation, we will have tutorial session for journalizing and solving income tax accounting. Thank you.